We're joined today with four very experienced people in the sector. Christian is currently Chief Executive of a SPAC, pre-deal, and has an awful lot of wisdom to share about what makes a good SPAC. Katie is currently Chief Legal Officer at Lottery.com and has recently de-SPAC'd and has, again, a whole lot of experience to share with us. Dr. Laila Mintas is a serial entrepreneur who has been involved in multiple transactions and has a huge amount of wisdom to share with us. And Adam Rosenberg has been in and around the sector since Noah got off the ark and has done a huge amount of financial investing and is also director of a SPAC. So with many, many different angles to talk about, I'm going to start off with Adam and just say, Adam, can you just talk about why a SPAC's been successful for iGaming and what's really happening in the recent years?
Okay. Well, I would choose a different word from successful because I think there's too much in that word, but they've clearly been prevalent. And so maybe to set the stage, it's helpful to just back up and remind ourselves what a SPAC is, very high level. So it's a publicly traded company that has capital, some people with expertise in an area, and a defined mission. And that's why it satisfies the regulations for going public. And that defined mission or the special purpose is the SP of a SPAC. So starting with that, I'd say there are three key reasons why they've become so prevalent and such a popular way of bringing capital to opportunity. One has to do with structure. So there are clearly structural advantages to a SPAC versus a traditional IPO in terms of timing and cost and efficiency to market. But there's also been change to the structure from a regulatory perspective that has made it more attractive for both sponsors and capital. And we're going to talk a lot about all of that. But just to give a little perspective, does anybody know when the first SPAC in the US was done? 1993, when I was finishing law school. So they've been around for a long time, but they've changed a lot. And I spent a lot of my career at Goldman Sachs. And in the early days there, we wouldn't do SPAC transactions because of the perceived or actual regulatory challenges. And that structure has changed dramatically. So I'd say, so that's one reason is structure. Two is the nature of our industry and how it has changed. So with the PASPA reversal and the proliferation of legalized online gambling and sports betting, that's created a new category of companies at scale that have revenue and prospects for growth, for very fast growth, but aren't yet profitable, a lot of them. And that's a formula for attracting capital in a hot equity capital market environment, which we've had over the last few years, past few months to the contrary notwithstanding. So that has been another reason why SPACs have become very prominent. And the nature of some of those businesses are such that the licensing requirement, which had kept institutional capital out of gambling for much of history, the licensing standards are not as severe for some of these technology-oriented businesses that are at the adjacency of the core operations of gambling. So that's two, is how the industry has changed. And then finally, institutional acceptance. So I left Goldman Sachs to join a place called Fortress Investment Group, where I spent the last 7 years, 7 years until a year ago. And Fortress has 4 SPACs. And that I think is symptomatic of how institutions have embraced a product that used to be something where an individual or a sponsor group decided they wanted to go chase opportunity and raise some public capital to do it. And now asset management firms, private equity firms, hedge funds, investment banks have gotten intensely involved in the product as a part of their toolkit to bring capital to opportunities. So those are the reasons that I think have all kind of coalesced to make it such a prominent product. And I think a lot of what is in there will be fodder for what we can unpack as a panel for the rest of the time.
And why has it been so relevant? I mean, Katie, you probably got the most experience in this most recently. Why is a SPAC so perfect for iGaming right now?
Well, I think it's been seen until even we can talk right now, I think in weeks, it's been seen as such an easy access to both capital, to then post de-SPAC, to really provide the entity with a new form of currency, and to provide it also with relevancy. when you're a young entrepreneurial enterprise, to be able to say that you're entering the public market space, it gives you a perceived prestige. One of the things that I would always say as a warning, though, is it's a lot like an 18-year-old girl who really, really wants to have a wedding but doesn't understand what a marriage is like. Being public is a lot like that. Right after this, I am going to race out of this because I've got an audit committee meeting and earnings on Monday. And once you're in the public company cycle, you're in the public company cycle. And all of the requirements and the focus that that takes, as well as meeting expectations, and we all know what the street is doing right now. I mean, everybody is taking a beating, and you don't get to hide from that. And so although you get the glory of seeing your name on the tower, and although you get the glory of being able to put some symbols behind your name in every press release, you also have all of the risks that come along with it, and that currency that you think you have may not in fact be currency. So it's been an incredible tool, I think, perceived tool for many of us in the iGaming and the non-brick and mortar space period. But it also, I think, we need to be attuned very much to the risks that are involved.
Fantastic. And Laila, how important is profitability, do you think, in the context of SPACs and secondary raising and taking the business past that first glorious ringing of the bell?
I mean, if we consider sports betting has been legalized in the US 4 years ago, so it's a pretty new and young industry, and many of the companies in the US that came into the US or were actually founded and created here, in their life circle, they're almost acting like startups. So it's a very high growth that they're projecting. Many of them are very far away from being profitable. And the spend is just immense when it comes to user acquisition. So in their life circle, it's very hard for them to do a traditional IPO because it's hard for many, not for all of them, but for many, it's very hard to show 3 to 5 years of existing revenues. And they're busy with their land grab, with their user acquisition, etc. So the vehicle of a SPAC just made so much more sense to them. It was so easy access to capital, especially with low rates, low interest rates, etc. They only have to show their projections. So you can basically raise a lot of money through a SPAC on future revenues. And I think that kind of like led to the SEC now to step in and kind of like adjusting the regulations. And we see nowadays, I mean, just in the last 6 to 9 months, how the stock market reacted, not only in our industry, but really in every other industry as well. Some of those brands are down 80% on their stock price. So we will see through that certainly a change in the environment here in the US when it comes to user acquisition, how those brands will react and act over the next couple of months and years. And it really makes one thing really clear. It's much easier to do a SPAC with a company that is profitable. And we just saw this morning, there was another SPAC announced, BetClick with Banerjee, the Endemol Group, $7 billion SPAC out of Amsterdam. So those companies are profitable. They have like high cash flows, etc. It totally makes sense to do a SPAC. And they will hopefully be trading way over $10. But what we have seen, many of the companies that were very high up 9 months ago, they're like way under $10. And just to avoid that, I think this SEC made now the step to revise the rules and regulation to make sure that doesn't happen too often in the future.
Fantastic. So Christian, what makes for a good SPAC if you're out there?
Look, I think the answer to that question has probably changed dramatically over the past, call it 18 to 24 months. And I think the right answer is probably still evolving. I think you touched on it. You have to have a real growth profile. Like you have to have real revenue, real growth profile, and you have to have earnings. The idea that you can go and burn capital, I mean, you can see what the markets are doing to businesses do that. it's very difficult, particularly in, particularly SPACs that are focused on the U.S. market or U.S. gaming market. Sports betting's expanded. The panels have talked about the opportunities of iGaming here in the near future. The reality of it is gambling has been successful where there's been limited supply and lots of demand. Where it gets to be lots of supply and the same demand, that's what you're seeing play out in sports betting, where the cost of customer acquisition is through the roof, hard to find profitability, as opposed to, you look across the pond or you look around the world, there's lots of markets where people have been profitable, but, there's probably, far more demand than there is supply in those markets. So it'll be interesting. But I think you have to have a real growth story, a real market, real product, and you have to be at least close to profitable. You have to have a very believable path to profitability, if not being profitable.
And Katie, if I'm sitting there as an operator right now thinking I want to go through some form of exit or listing, how do I choose a SPAC? What makes me choose a SPAC over an IPO? Where do you start?
Don't.
Do you start?
Yeah. So that advice aside, look, I think, Christian's advice is the right one. Be profitable. And then, and the SEC has come out with this exact guidance, and the rule changes are upon us. They are treating this now like an IPO. So, 10B is going to be looked at very hard. 14C is going to be looked at very hard. And what all of that means, if you are not a lawyer who's spending your time looking at the 33 Act, presuming most of you aren't, please don't. But what it really means is that full and fair disclosure is upon us. So the days of going out and being a SPAC where you could pluck out of thin air what your future projections are going to be, those days are gone. And there are many a SPAC out there where that really was what the projections were. You would say, we're going to do 6 M&A over the next 2 years, which means our revenue is going to look something like, and pull a number. We now need and should have SPACs that look just like an IPO. It's just a faster way to get there for a company with a smaller enterprise value. We are also seeing many of the major sponsors walking away from these deals, and they're walking away because of liability. Again, which points directly to these need to look like IPOs, just on a smaller scale, which means that the liability risk has to be de minimis the same way it is with an IPO. There needs to be an appropriate board of directors. There needs to be appropriate internal controls. There needs to be audited financials that are done in accordance with GAAP, presuming that it's a U.S. entity. All of these things need to be aligned and in place going way back, not something that you are doing in the months leading up to the event. And then in terms of what you select, I couldn't suggest hard enough the alignment between the SPAC sponsor and the entity. Misalignment is going to create, again, issues where you are making a poor marriage. A SPAC shouldn't be seen as anything less than what it is, which is a merger. And the same way that if you were going to go into an undertaking and you were going to merge your company, you would do that same due diligence and you would look for those same synergistic undertakings and for that same coalescence on a going forward basis, you should do that with your SPAC sponsor. And if your SPAC sponsor comes from a different sector or a different perspective or a different philosophy, it's going to make for a terrible marriage. And that's not the best way to start what can be one of the most difficult in terms of newness periods for an organization.
Fantastic. Adam, raising money through a SPAC is expensive, right? You've got the sponsors promote, you've got all of these warrants floating around. Looking at it as an exit for private equity, how do people react to the concept of SPAC? As far as I'm aware, the only people who've done it is Apax with Genius.
How has private equity responded?
how would private equity view an IPO exit through a SPAC rather than straight IPO?
Well, I think, I mean, I'll pick up on something Katie said. I think you have to recognize that an IPO is a fundamentally different thing than a merger, than M&A. You know, an IPO is a creature of disclosure. M&A is a creature of negotiation. You know, an IPO is about raising new capital to get people behind a story that is to come. And M&A is about convincing existing capital that they're better off in a combination that already exists, you know, separately and now will become, you know, one, but the business already exists. So, you know, private equity, I think, is, you know, a creature of economics. So if there are SPACs, either before they've de-SPACed and done the merger or afterwards, that present a compelling forward return story, there's no reason why private equity wouldn't and shouldn't look at those. And in fact, they are. So I think the more the SPACs are regulated and the more they go through the regulatory cleanse that Katie described, and the more regulators are focused on making sure the disclosure is as fulsome as it can be, the more likely you are to get private equity treating them as they treat other, you know, target companies for capitalization or acquisition.
Super. Just turning to the process and the de-SPACing process, Katie. If someone's going through this process, and you know, I accept that in the near term that might be slightly unlikely, although there are a lot of SPACs out there looking for deals on relatively short fuses now. What are the things you should be aware of as a corporate coming through? What are the bumps in the road? How do you make sure that what you're going to do doesn't crash and burn the, you know, half an hour after you've consummated the transaction?
I mean, the best advice I would be able to give, I think, is constant disclosure. We were lucky enough to have less than 1% of redemption, which, especially at the point in time when we did it, was truly it was just a remarkable achievement on behalf of our team. And we did that by over disclosure. You know, we did incredibly simplistic disclosure where we made sure that our retail investors, our institutional investors, and our regulators across the board constantly understood where we were in the process, and that what we said we did and what we did we said. And that to me is, it's a mantra that we lived by going into the process and that we have continued. Everything that I have seen so far, where in the de-SPAC process, entities on either side get themselves into trouble, it's because of a lack of disclosure, and it's from a lack of being forthright, either with their sponsor, with the target, or with a regulator, or with the retail investors. Do not underestimate the power of the retail investor. The more disclosure you can create, the better your result's going to be. And you know, being able to have a result like ours, where you get literally, we had 0.4% redemption, is the result that you want to end up with.
So Christian, as a SPAC sponsor right now with the specter of redemptions out there, how do you manage that process? How do you select the right company?
Look, it's, as I think Adam touched on, it's a negotiation, right? So when you're looking at a target company, they're looking for capital, right? That's the attraction of a SPAC, is that you have this pool of capital that they're going to be able to utilize to grow the business and execute on the plan that you're putting forward, right? So given that redemptions, you know, I don't know the statistics, but you know, it's very, very rare you see one below 90% redemptions. And so there's a certainty of capital question that targets are having. So trying to work that, I don't think, I mean, most people have heard about pipes. I don't think they exist anymore. Adam, you probably are closer than anything. I just don't think they're there because there's other options. Why do people want to be locked up? There's other ways for them to play in the game. So you have to be very transparent with your target and figuring out what you're going to do. And I think Katie hits on it, right? It's about being transparent with the target, having your goals in align, and making sure everybody's on the same page, good, better, and different, right? Create the story, tell the story. You know, you create the narrative and make sure that you're very transparent in what you do. You have an opportunity, but that starts before going public, before being in the public market. Be there with the target. Say, look, we want to deliver as much capital as possible, but that's going to be a collaborative effort of telling the right story and having the right story to tell. So it's definitely part of the negotiation now about how much capital, minimum cash requirements to close. It's very, very difficult. I think you'd be foolish if you relied on anything but that high redemption level. So to the extent you have to solve the calculus, I would assume that what you're going to get in trust is going to be pretty low.
Right.
Just to build on that, for the benefit of people in the room who might not be as familiar with what we're talking about, the relationship between redemption and PIPE is something that I think gets missed, which is one feature for investors to invest in a SPAC when it lists, so before a de-SPAC process merger happens, is the promise of being able to approve or not approve the ultimate merger. And if you vote against the merger, there are different variations on how these deals work, but in general, you get your money back, right? So there's embedded option value for investors if they want to preserve the ability to turn down the deal, they can get their money back. And that's the redemption part. Now, the reason that matters is the SPAC, someone in Katie's position, has to now manage the acquisition price for the company that they're buying when they also have to pay a lot of money out to the market to redeem the existing investors, some percentage of them. And that hole has been filled with this PIPE, a public investment into a private investment into a public entity. That's what a PIPE is. And so the more redemption, the bigger the PIPE need is, and you have to solve these things simultaneously. So I just want to make sure we're being clear about why these things matter and how they relate to each other. And again, I would come back to, I don't think that PIPEs are dead. I think they have to be compelling. But if so many investors are redeeming, that replacement capital is going to have more risk associated with it and be more expensive. And then at some point, it becomes harder to make the merger work because, again, all of these things feed back on each other. So I just wanted to make sure we pointed that out.
And then presumably, once you get it all away, you've got an overhang in 6 months when all of those locked-in holders start dumping their stock in the market.
Yeah.
You've got to fight your way through that too.
Yeah, well, you could get creative on lockups too to try and create the right incentives. But, it's another problem with a lot of SPACs is they have very low float because the sponsor group and big owners who need to be locked up and the PIPE investors get locked up, there just isn't a lot of trading. And so when there's downward pressure on those stocks, there's not much support. So it's another challenge to the structure. And that changes over time as the lockups, abate and people can create more float. But it's a feature of the company.
If I could, I think that's such an important point. And if there's one piece of advice that I was going to give is the creativity part. I think the race to the finish line, everybody tends to go to the same shops, do the same thing, use the same forms, and race to the finish line. And you lose the creativity. And in losing that creativity, you lose an enormous amount of opportunity, which is going to cost you in the long run. And taking that sober second thought and maybe looking at other opportunities in the process to be creative it can net you an enormous amount of wealth in the process and bring you an enormous amount of benefit, which will give you a lot less regret at the outcome.
Fantastic. So I was going to pronounce the death of the SPAC today, and then Betclic turned up with the Endemol business and did the European SPAC, which is the first one that I'm aware of in Europe as a SPAC. And I think listening to all of you today, I think the SPAC isn't dead; it just needs to be reinvented.
It's only mostly dead.
Yeah. This isn't a dead parrot. But I do think that there's going to be a future for the SPAC. I think there is a lot of money currently sitting, waiting to be deployed or redeemed. There are a lot of clever people out there who I think are going to have intelligent ideas about how best to deploy that capital. And I think if you bring a project forward which has got the right combination of profitability, believability, management teams that are proven to deliver things, then I think there's still a future. And notwithstanding all of the issues where people are pointing to value destruction from, be it DraftKings or whomever else, and it always comes back to DraftKings apparently, then from my perspective at least, and thank you guys for contributing and helping me with my opinion, I think it really is, there's something that will still be there, but it'll be there in a different way. And we just need to sit down and work out how to make that work. So thank you all very much.
Thank you.